Hi everybody. We'll just give it a moment before we start to let everyone join us. Okay, well, let's make a start. So good morning, good afternoon, good evening to you all, wherever you find yourself in the world. It's great to have you on board. I'm Professor Alex Nicholls from the Side Business School, University of Oxford, and I'm the academic director of 4 of our impact programs that we offer at the University of Oxford and the Side Business School. These are executive education programs that we've normally offered over 5 days in Oxford residentially, but over the past 18 months, as has been common across the world, we've been doing these virtually. So we've been doing 3 of these virtually up till now, and we'll be offering 2 others this year. So the Oxford Social Finance Programme will run in September and October of this year. And then really the purpose of our discussion today is the Oxford Impact Finance Innovations Programme, which will run at the end of the year in November and December. So over 10 years, we've built up a portfolio of work across this space, and we continue to move that forward, which is really the point of our discussion today, is about the next iteration of our programs with our esteemed colleague, Aunnie Patton Power, who's here with us today to talk about her work in that program and also her exciting new book. So in terms of today, we will do a brief introduction in terms of some slides from me. Then I will turn over to Aunnie to talk through a couple of questions from me, and we'll have a conversation and allow plenty of time for a chat with you and to listen to your questions and answer them as best we can. If you can use the Q&A function on your screen, that'd be much appreciated. And that way we can try and capture as many of your questions as possible in the conversation today. And if possible, even follow up afterwards if we can have some information about who you are and your questions if we can't answer them all today. So it should be very lively. It's great to have you here. This is a subject we're passionate about at Oxford and also individually, Aunnie and myself. So let me just very briefly give you an overview of this topic and then hand off for much more detailed discussions with Aunnie about her work. So I hope you can see the slides. So this is what we're covering today in the webinar. So really it's about looking at the next set of agendas and opportunities for impact investors to go beyond some traditional structures. And this is really where Aunnie's work has been incredibly influential, both in terms of practice and analysis, and most recently writing up in a brand new book about understanding where innovation lies and the opportunities for innovation lie in this peculiar world of impact investing. And particularly we'll talk today about new types of deal and fund structures that may better align capital and impact. So these are really, really cutting edge discussions, but crucially important to the development of this field. All right, so let's just quickly sketch in what I think we're talking about. So we talk about impact investing, impact investment, impact finance, call it what you will. We've got to get our head around what impact is. And the problem we have sometimes in this space is there are many ways of interpreting this, and you can stretch this term widely. I think we have to be fairly precise if we're going to get to nub of what we can do with this type of finance. So a reasonable definition of this one we use in our work, we teach an impact measurement program as part of our exec ed portfolio, and this is what we use for that program in terms of defining impact measurement. So social and environmental change is critical. This is a delta question. What is the change that's being brought about? There's materials, so it's relevant, it matters, it's in alignment with what we're trying to achieve, and is additional. And let's remember it can be positive or negative. Now, we're pretty much going to talk today only about positive opportunities, but it's a really important reality check to make sure we understand, our investment choices can have negative effect as well. And in terms of measurement, that's critical. So if we flip that into impact investing and impact investment, then I think we can reasonably say, and I hope Aunnie will agree with me, that it's capital allocated with the intention of creating additional positive, there we go, that's the intention for positive at least, social and or environmental change together with a financial return. And the financial return, of course, could be many different types of return. It might not always be market or above market, though those are available options in some instruments and funds and investments. So it's taking that delta of change, that intentionality that we had in the impact definition, and aligning it with capital allocation and a financial return. So just a couple more kind of scene setting slides. This is from Credit Suisse's work on what they call a double delta of impact. It's slightly complicated, but really I think this is a useful and interesting slide, and it reminds us that when you think about impact investing, the capital allocation, you can have two deltas, two changes, two sources of impact. One can be at the organizational level and one can be at the capital level. And really all this is saying is that you can have capital that's allocated towards the growth of a company that already exists, and which can increase its impact by the capital allocation, and or it could be new money. So it could be, if you have the new money and the exponential growth and impact because of the capital allocation, you have a double delta. If it's moving money around that's already invested, but allocating it differently or in different formats to a company, it would be only one of these. So the sweet spot is kind of new capital for growth, startup and growth of innovative impact organizations and investees, at least in the Credit Suisse world. And I think this is quite a useful way of thinking about it. This notion of double delta impact is quite common in this field. So that's another way of thinking about what this is. So just briefly on demand and supply. So we might as well use the SDGs. That's where people align a lot of their thinking. They are sort of catch-alls, but the key point we have to remember is that whatever the number you want to come up with, and maybe this is a modest number, there is a significant annual shortfall to 2030 around what we need to achieve the objectives and the stated outcomes of these 16 categories and the 17th about partnershiping. What we know is existing money in governments and DFIs won't address this, so there has to be a private capital play. A lot of focus is on what do we do to play a part in addressing this substantial shortfall in the need for capital. On the other hand, a couple of things that I think we can say are positive. So this is an old slide now, but I think it's still useful. There's a lot of SDG aligned sectors, which are growth sectors. So you can see some of these in microfinance, well understood, but also in renewable energy, sustainable agriculture, you can see education, health. So many of these are growth investment areas with strong and interesting opportunities for new capital to actually produce attractive returns, as well as having SDG impacts. There's a lot of alignment with some of these categories, not all, with the SDGs. And that's one way I'm sure that we can see capital moving. And the other is a wealth transfer question. This is maybe important for foundations, but also for impact investing. You'll see the numbers here again, slightly out of date. It's probably a bigger number now, but intergenerational wealth transfer from the boomers to their children will be the largest transfer of capital in the history of the human race. Let's say $60 trillion of wealth. And a lot of that's going to go towards women, more women than men, in the demographics of that generation, whatever we're going to call them. And those women and the millennials generally have stated interest in allocating capital for impact. So we've got this wave of capital that's coming through. It's one reason why many of the big investment asset owners are looking at how they can satisfy this incoming demand for impact and environmental related investments. So we've got lots going on. Finally, just another quick mood setter. This is from the GIN, the Global Impact Investing Network's annual survey. It's a little bit old now, it's 2020, just to show where the money is being placed. Now, this is their sample of 289 asset managers. So it's by no means the universe of everything. So it is a biased sample, but you can see that in their sample, most of the, or 21% of the assets under management are in private debt, then public equity and private equity really dominates. And what you would see if you compared this with a couple of years earlier is that public equity is leaping up this chart. It used to be private debt, private equity, now public equity is coming into this. We could debate in our questions why that might be. But this is a sense of the landscape. So I think when Arnie's going to come to talk about innovations in some of these spaces and the limitations, it might reflect these patterns that we see in the GIN survey. Okay, so just to tee up our conversation then, as I mentioned at the beginning, we're launching a new program at the end of the year, which is being led and curated by Aunnie and reflects her extraordinary work in this space. I won't do too much of a hard sell, but a brochure and the information is on our website, and it will launch in November of this year. Here's a sense of what's going on. I won't go through all of this, but it's on the website. I mean, much of what we're presenting in that program will also be in discussion today about essentially, as you know, the focus is in the name. This is about innovation and cutting edge and what's happening next, not so much how do we understand this, the sector. We have an impact investing program that in a sense provides that primer for the field. This is the more advanced, if you will, or innovative program. All right, so let's now hand off to the real point of today, which is Aunnie. So you'll see her stellar profile. She has a background in financial investing, both in the real world, which she got out of quite quickly, but also in the impact world. And she has appointments at the LSE and at Oxford, and she's the director of our program that we're just mentioning. And hot off the press, I think it's been out for a month now, no doubt top of the Amazon charts, is Aunnie's wonderful book, Adventure Finance, that she'll talk about today. So, so let's tee that up. Let's me just get out of my slides, and then we'll tee up some questions, and then we will come to talk with all of you. So let me just get out of this, and we can see Aunnie, so that's wonderful. Okay, so let's just let's tee up a few questions, as I say, and then we'll open it up. So Aunnie, in your book, you say that venture capital doesn't work for most impact enterprises. Can you say about more why this is and what the implications are for impact investors and social entrepreneurs?
Sure. Thanks, Alex. I think, it's one of those things that I've been saying for years, and it's frankly one of the reasons that I wrote the book, is that my own impact investing journey, as you know, started almost 12 years ago. And really at the very beginning, the impetus was to prove that we could do well by doing good. And I think that, there was definitely a small set of us that were very, I would say, concerned, interested in how we allocated funding, not just to what we allocated funding. And you and I have had having these conversations for almost a decade as well around, what do the structures look like? Are we just replicating the traditional financial market? And I think VC is a really good example of that. So there are some wonderful things about what venture capital can do for social entrepreneurs, but at the same time, if it's the only kind of risk capital available, it means that social enterprises need to look exactly the same as traditional grow at all cost, boom or bust financial enterprises, traditional commercial enterprises. And that's not what we're looking for. We're looking to remake the system, not just to replicate it. And so for me, the concept really is that VC doesn't work for 99% of businesses, impact or not, but particularly impact businesses. And this is because venture capital was designed for a very specific type of company: tech-enabled, asset-light, highly scalable. And throw it into the structure of needing to have a traditional founder that looks like the type of VC founder that you are used to, which most VCs are looking for, which is the tech bro in a hoodie. And we have this model then essentially whereby we've taken within the impact investing world and said, we're going to provide risk capital to social enterprises, but we're going to still need them to be tech-enabled, asset-light, highly scalable, and willing to grow into unicorns. And if we look at who social entrepreneurs are, is yes, they want to solve big problems, but they don't always want to have a growth at all costs mentality, and B, they may not want to exit their company or lose their ownership over time of their company, which is required with a venture capital model. And so really what I mean, it's the entry point, as you know, to a lot of these different options, and we're going to talk about some of them today. But for me, it's a fundamental point of saying that the traditional options for investment in early stage financing are generally not the best options for social entrepreneurs. And so as impact investors, I think really the push is to say, can we create structures that encourage the enterprises that we want to invest in to actually solve the difficult problems, and then don't just push for them to be the social Airbnb, the social Facebook, etc. And so that's really the fundamentals, the jumping off point for the book and for a lot of my work, and some of the structures that we'll talk about today.
Yeah, thank you. So, I mean, given this, and one of the great joys of the book is the richness of its examples as well as the richness of its description of alternatives. So, given this situation with VC, what do you think some of the alternative structures for risk capital should look like? I know that you talk about them in many forms in the book. Could you take us through some of those alternatives?
Sure. Yeah. So I think I'm only going to go through a few. As you know, there are a lot of chapters in the book, and the course is going to be 6 weeks of, really unpacking this. But four that fall under the heading that I call structured exits, I think are really important to think about when we are thinking about alternatives for risk capital. So the important thing to remember is that we still need risk capital. Enterprises are not going to be, very scaled, very stable companies looking for traditional debt financing. We still need to find ways to do risk capital for a variety of different types of organizations, but also for a variety of different uses. So one of the things that has been used historically that I profile in the book that's also an interesting option is something called mezzanine debt. Now, mezzanine, as many of you know, is used as a catch-all term for a lot of different types of capital. In this case, when I say mezzanine debt, I have a specific definition for it in the case of the book and the example, and then also when I'm talking here, which is a loan that is paid back with some sort of fixed interest, and it has an upside component, which means that there's either warrants, which can be equity or ownership, or it's a profit share. So it might be a $300,000 loan that has a 5% interest rate, and then the borrower also has to pay 2% of their profits over the time of the loan. So there's both a fixed component as well as an upside component. Revenue-based financing, which is another type of structured exit that looks very similar to kind of debt, but it's this bit of a hybrid, is a debt agreement. But what is different about it is that to qualify for it, the funders actually look at the historical revenues, sometimes as little as 3 months historical revenues, and then the repayments are completely flexible. This is one of the things that founders really struggle with debt, is that they can't take on a fixed payment going forward. Either their companies are seasonal, or they're just so early that being able to make a specific payment every month just doesn't make any sense. And so what revenue-based financing allows companies to do, even early stage companies that have small amounts of revenue, is to repay this loan as a percentage of revenue over a period of time. And this is it's a pretty simple product, actually, that has just not really been used much. It's starting to grow significantly. One of the largest and leading revenue-based financing providers in the US actually just raised $215 million last week. And so this is becoming a big option now, and is starting to, and which I did in the book, is actually an option in emerging markets as well. And so what I'm seeing across Latin America, Africa, and Asia is that these small fintechs are coming up to provide this type of financing, sometimes alongside VCs, but even to very small businesses. For instance, Viwala in the book does this in Mexico, and they can do it for very small female-owned businesses, and are able to then get the repayments. They're linked up to the Mexican tax authority to be able to actually see pretty quickly what the repayment should be and be able to pull out that cash. And a slight twist on this is something that I call convertible revenue-based financing. I say I call because there's a lot of different terms here, but it's the same type of thing as revenue-based financing, but with a convertibility option. So this is something that's a little bit closer to equity financing. So the investors would look for a repayment based off of revenues or cash flows in going forward, but they also would have the right to, if the company does, for instance, raise equity or get sold, or have some sort of what we call liquidity event, then the owners of this revenue-based financing would be able to convert into equity owners. And this is something that we've seen, for instance, really has honestly been created by impact investors, and called a few different things. A variable payment obligation is one of them that John Kohler created. And it was to be able to give entrepreneurs the option to not raise equity. So instead of VC requires essentially companies to go out and raise equity to continue to be able to grow. In this case, a convertible RBF could be a loan that could be paid back, and then there would be no exit requirement. And then finally, for me, one of my favorite structures in the book, honestly, is something called redeemable equity. Now we're going, as we move kind of further to the right, we get even closer to traditional equity. Redeemable equity looks a lot like traditional equity, except that there is a clause in the agreement that essentially dictates how the entrepreneur can exit by repurchasing the shares. So investors put money up front into the company. This is pre-revenue. The other three are post-revenue companies. So this is for pre-revenue risk capital. So investors put money in, but instead of a traditional equity investment that looks for an exit from a trade sale or from an IPO or from a sale of the company to a financial buyer, redeemable equity allows part or all of the shares to be repurchased from the investor, either at a predefined multiple, so say 3 or 4 times what the investor paid for them, or at a mutually agreed amount, which means you can have a valuation done of the company at a later stage. So for instance, I have an example here, and I'm happy to go through some more examples if people want with questions. I've got some more slides after this. But so example, if an investor put $30,000 into the company for 10% of the company, they would have paid $300 per share. And those shares would be redeemable at 4 times. So they'd be redeemable at $1,200 a share or $120,000. And with these contracts, you can really scale them up and down. So you could have 50% of the shares be redeemable or 100% of the shares be redeemable. And what each of these allows an entrepreneur to do is to choose what type of capital makes the most sense for them, but also it allows the entrepreneurs to choose the path that they want. So you could have an early stage company raise convertible RBF or redeemable equity at the early stages of the company, go on to build a revenue positive, sustainable company, and be able to satisfy their investors by essentially giving them the return that they're looking for without needing to go to unicorn status and be able to be sold off to an entrepreneur, to a large company. So what we've seen in some of these are new instruments, we only have a few years really of examples, is that the organizations that have taken on this type of capital have sometimes gone on and raised traditional equity capital. And so they've converted it and they've taken that path, and have other times have just financed it either internally or by being able to access bank debt and other types of funding that is what we call non-dilutive. So it means that entrepreneurs can continue to own and control the company from a mission perspective. And also they don't have to get into something that I've seen firsthand quite a lot, this VC mentality of, boom or bust, that enterprises, social enterprises may not be wanting to play the short game. They may want to be playing the long game. And the way that traditional equity sets them up is that there has to be continual growth over a short period of time because the fund structures of the VC funders require that. And then just one more thing to say on this before we go on. I'm just actually going to skip through those. Oops, there we go. So this is what a traditional venture capital portfolio construction looks like. You assume that you're going to have one home run, which is going to get you to 10 times.
We can't see the slide. Is there be another slide? All we can see is the structured exit slide, the first one.
Oh, thank you. I don't know why I did that. Here, let me stop and then I'll pull it back up. There we go. Now can you see that? Cool. So you assume that there's one that's going to do a cash on cash return of greater than 10 times. That's a home run. I have in the book, and as I've done here, have translated this into other sports other than American sports. You assume that there is going to be about 3 that hit between a double or a triple, or between 2 and 5 times. A few that kind of return 1 time to cash, and then a lot that strike out. And this is approximate. You're probably going to have quite a few that strike out. But in average, what it gets you to, which people don't realize, is around somewhere between 2.7 to 2.9 times what's called cash on cash. So if you've put $100 into the fund, you would get out $300, somewhere between $270 and $300. Now, the reason VC portfolio construction looks like this is that it's betting. So you're essentially betting on a lot of companies, hoping a couple do really, really well to make up your whole return in essence. So what's a little bit different with structured exits, and what can be quite interesting, is that structured exit investors can oftentimes, they don't have to, but they can oftentimes target a very similar average portfolio return. It's just the composition looks very different. So instead of having one company blow the lights out, they're going to have 70 or 75% of their portfolio return around that 2.7 to 3, maybe 3.5 times return, and then have some return from the rest, or maybe no return from the rest, but actually still targeting that relatively similar cash on cash return. And what I like about this is that one of the things people always say is that you have to compromise somewhere. We've had this discussion with impact, and we can have this discussion. There's lots of ways we can play around with, obviously linking impact and changing returns, but there is a possibility that you can, as an investor, switch types of funding and completely rethink portfolio construction to make this still work for limited partners. And in some ways, those of you on the call that are in finance, which I see a lot of you are, you're thinking about higher liquidity because you're getting payments earlier, and better track records because these companies are often post-revenue, depending on what type of structure you're using. So this is, we don't have a lot of data on this, but what we've seen so far is that there's been some pretty successful funds. Adobe Capital is one of them in Latin America that has done this, has been able to return cash to their LPs, their limited partners, at a rate that other venture capital funds that are considered more successful have not. So I think just kind of in summary with that is that there are options, including the ones that I just brought up, for us to really just completely rethink how we allocate risk capital, and potentially align that better with the actual needs of underlying enterprises.
Thank you. I mean, just a couple of questions from the chat before I come back to the question for you. And they're both really about the investor perspective. Now, obviously, Adobe Capital is Adobe Capital, but I mean, the question people have posed really is, why would you take a redeemable equity option ahead of traditional? I mean, why in a sense would the investor choose these complex structures that seem to be designed to make life easier for the investee, maybe not the investor?
Yeah, it's a great question. And it's often the first question. And so it's a perfect one. That's kind of why I threw in that portfolio construction there too, which is that, the mentality, the betting mentality. I do equity investments myself as an angel investor. And part of what we do is we do some kind of redeemable equity as well as traditional equity and revenue share. And so we choose based off of the entrepreneur. So there's a couple of reasons. So the first reason is obviously that you're trying to open up your funding to more companies. So one of the things that people complain about, which you know this, Alex, in the impact investing world, is there's not enough investable options. And part of that reason is that there's not enough companies looking for equity. So then the question becomes, is do you keep trying to find those companies looking for equity, or do you potentially add additional tools to your toolkit to look for other companies that aren't necessarily looking for equity or aren't going to make the equity style returns in that regard? So that's one thing. So it gives you a bigger pool to choose from. There's more post-revenue companies that are looking for capital that are not going to grow to be the next Facebook, that are in a $10 million, $20, $100 million market, not a $10 billion market. The other reason is around liquidity. So venture capital funds work the same way that venture capital portfolios do. Some venture capital funds make a lot of money. Some venture capital funds make no money. And actually, on average, there's several of our colleagues in the finance department have looked at the data and actually shown that on average, venture capital funds don't make money. But you don't know that until 10 years down the line, really. So it's a locked up investment that you put into a manager, and then as an LP, as a limited partner, you find out essentially 10 years later if you've made any money. What's interesting about bringing forward some of this liquidity and getting payments that can be then used as dividends to LPs is that you can start showing returns much sooner. And so as a GP, as a general partner, so a manager of the fund, you can start to see cash flows earlier, potentially, and be able to still have some of that upside. Now, for the redeemable equity in particular, what I'm seeing is that it's often partial. So you'll have a company that looks more like a VC that's purchasing 100 shares, but only making 50 or 60 of those redeemable. So they can actually make a return, maybe a 2 or 3 times return, or maybe more on their money by having those redeemable, but then they also have that upside. So if the company does end up going to the moon, then they keep that. Whereas with the convertible RBF and RBF, what they're seeing is the revenue-based financing, fintechs and funds that are starting up, this money is churning. So sometimes it's being repaid in 3 months, 4 months, 5 months. And so they're able to see returns every year to be able to return to investors. So I wouldn't say that all traditional VCs are suddenly going to, close up shop and start using these types of structures. But there is a strong argument to be made in using these either as complementary or as kind of hybrid structures, or also just as completely different fund structures. So you see traditional debt investors that are actually looking for a little bit more risk as opposed to just the traditional equity side. And I think just the last thing to say on this is that as we've seen in the market, there's a lot fewer companies going public than there used to be. And so the question becomes is if you're requiring an exit, how many corporates out there are really going to buy you at the amount that you need, and or financial buyers if you're not going to go public? And so there is a real question around the validity of the VC model. I think that is a fundamental question just in general.
Just while we're on this, before we carry on, Alberto asks about time limits or time setting for redeemable equity. How do you negotiate the time frame?
So it's a very good question. So what I'm seeing right now is that, and this is where for me, this is my first book. My next book's on fund structures. So this one's on deal structures. And what you start to see when you start to dive into these deal structures is that they can make the case for changing the traditional LPGP fund structure, which is 10 years plus 2-year extension. So you've got 12 years to get your return, which is just not enough. If you look at even very successful companies that have gone public globally, most of those have not returned their investment to their investors in 12 years. It's a very short period of time, actually. And particularly if it's taken a couple of years to invest, then really you've got kind of that 7-year window. So what I have seen is that investors that have a traditional LPGP model will do it in that time frame. So they've invested and then they'll look for the return, within kind of 5 to 7 years, because that's what their fund looks like. But investors that are coming from either a permanent capital vehicle, or that's a family office, or that's a DFI, or an organization that isn't constrained by that, they're able to set those a little bit more relevant to the entrepreneur as opposed to only to their fund structure. And I think that's what's going to start to be interesting. Historically, the ones that the contracts that I have that I've been able to analyze have been more predominantly from traditional funds. And so what I'm excited about is as we see these non-constrained funders, what does a time frame that actually works for the entrepreneur that also provides the return for the investor look like? And there's more and more of these kind of fund structures that are non-traditional, which we'll also be discussing in the course and happy to talk about here. These types of deal structures actually really lend themselves to new types of fund structures. So one of the things with permanent capital vehicles is that people always ask, well, how am I going to get my return? Well, if the permanent capital vehicle is investing in things that have liquidity, then there's the ability to start spinning off dividends to be able to pay people out of these permanent capital vehicles over time.
Thank you. I just want to say a big shout out to the chat and just say hello, everybody. It's lovely to see so many of you saying hello. And some of you are old friends. We've known you for the programs or for the business.
I agree.
But for all of you, I can just notice lots of people saying hi and a wonderful range of countries and perspectives. So thank you just seeing the chat for being with us and being such a great group. So just on these questions of appropriateness of structure, I mean, one of the great joys of the book is the richness of the case studies and the detail of the examples. Do you want to talk a bit about how, what situations, what organizations, what type of organizations are most appropriate for some of these models, and how does that fit? Yeah,
absolutely. So what I found is that here, and I'll share one more slide here. So what I found in general, and you'll see this in the book, is that there's, one of the things that was the most difficult piece of the book was to try and, create these categorizations of what works for different fund structures, just because we don't have different deal structures. We don't have a lot of data. And so I would have loved to have had, hundreds and hundreds of deals I was sifting through. But in most regards, I was I was finding the deals that had been done in the space. And so what I've created, and what you can see actually, if you go to the website, or I'll just put it here for the book, there are some additional resources that allow you to go through the evaluation, the founder evaluation, that can be useful in trying to decide some of these pieces. But just in 3 of the ones that I've talked about, here's some suitability. So for revenue-based financing, these need to be post-revenue companies. So there's been questions again and again, oh, can't this be pre-revenue? And I think really where I've come down to with a lot of the investors that have done this for a period of time is that no, they have to be post-revenue companies, even if it's a small amount of revenue. But that being said, they can be early stage, they can be growth, scaling, established. One of the companies that I profiled in the book is an Indian company that is particularly in a niche that's very similar to what the European and the US revenue-based financing models are doing, which is tech companies that want non-dilutive capital for marketing costs, marketing and customer acquisition. So essentially what these tech companies previously had to do was to sell equity to be able to go out and buy Google AdWords. And that doesn't make any sense, because you're giving someone ownership of your company forever to go essentially acquire a few customers. And the VCs didn't like it either, because they wanted their capital to be used for long-term growth and investment in infrastructure of the company, people, development, all that stuff. So that's where I see revenue-based financing being really interesting, and for impact organizations that are interested in being able to do that type of customer acquisition and growth, and be able to turn that type of capital around, and even very small companies. So Vuala in Mexico, there's, and even in GetVantage in India, is doing very small, like $5,000–$10,000 loans. And this gets to one of the things in impact investing that we always talk about, which is it's impossible to do small deals. And when you start integrating tech and these types of very templated, relatively low diligence types of investments, you can get down to pretty small dollar amounts, which is something that we know is needed. We know that $5,000 to $50,000 is a huge need across, particularly for working capital. And in the book, I also discuss something called trade finance, which is also really relevant in this area. And then variable payment obligations or convertible revenue-based financing, also post-revenue, but more for medium term. And these are kind of stable or high growth companies, whereas redeemable equity can be pre or post-revenue. And these can be concept or early stage companies. These can be very, very early stage companies needing much more long-term capital, but they have to have high growth projections, because this is going to be more similar to a kind of traditional VC model. So that's just a snapshot. So in the book, and as we'll do in the course, each structure based off of the experience of the organizations doing it has a type of category of a set of self-evaluation that I can actually just quickly share here as well. So just using this evaluation, which I won't go through completely, to be able to understand the type of structure that makes the most sense, just understanding who you are as a founder, how mission driven you are, and what your funding needs are, to really be able to understand if this type of structure is worthwhile for you.
Can we just dive down a bit more into the questions about debt then? I mean, so William has a question about collateral, in terms of the investee covering risk and how that can be tricky for small enterprises. So maybe you can say something about the collateral models for some of these debt options. And you also have an example of the Kenyan artisans in the book. When you talk, I think, more about appropriately structured debt. Can you say a bit more about that case and maybe the collateral question?
Absolutely. Yeah, absolutely. So one of the things that is the most difficult about debt is collateral, which as you picked up in the chat. So having traditional assets as this early impact entrepreneur, or just a small impact entrepreneur, really holds back a lot of impact entrepreneurs from accessing debt, and holds back funders from being able to issue debt, also as far as the sizes. So, one of the things that I talk about in the book are ways in which you can adapt to be able to use different things for collateral. So for example, here, I'll just share this as well. There we go. So this is a bit of a heuristic that I designed to be able to think through what types of structures, just very quickly off the bat, make sense for you. And as far as collateral goes, you can see in that section, there's actually a lot of different things you can use for collateral. So you can have the traditional physical assets and a credit history. You can also get a guarantee from a funder. And this is something that I profile the Skoll Foundation's guarantee in the Gambia for Riders for Health as an example of a foundation that was willing to essentially use their balance sheet to allow an enterprise, a nonprofit in that case, to access cheap debt. You can also use invoices, purchase orders, and your history of fulfilling orders. And this is where, as I just mentioned, invoice factoring, purchase order financing, and something called supply chain financing come in. And these are all really useful options for early stage, or doesn't have to be early stage, small companies to access working capital. And I'll talk through one of those in a moment. Now, we've talked about revenue-based financing. Revenue-based financing uses revenue as a collateral. So instead of needing assets, you're essentially saying, this is how much I've made in recurring revenue, and this is how much I'll be able to pay going forward. And that's the type of due diligence that RBF funders do. And venture debt, which I haven't brought up yet, is a type of debt often looks like mezzanine debt that's used and essentially uses venture capital funding as collateral. So they go in and you won't have traditional assets, but if you already have funding from an angel investor or from VC that the funder, is respects, then they use that as collateral. So there's a lot of different ways you can play around with instead of having traditional collateral. And I'll just quickly do, I know we're kind of running out of time, but the Powered by People example is a good example of purchase order financing. So I'll just pull that one up quickly. So got a lot of cases in here. There we go. All right. So this is an example, and it's a little complex, but I would have to say purchase order financing is one of the most complex structures in the book. But essentially what happens is that these artisans or any sort of small social enterprise or small small and medium enterprise has an order from a large organization. And they often struggle to be able to access the working capital. They don't have collateral to go access debt to be able to actually put together, in this case, say these are these woven baskets. So you can have purchase order financiers, which will step in as a third-party financier, like Powered by People. And in essence, what the artisan does is they take that purchase order, to Powered by People, and Powered by People gives them an advance on that purchase order. So they buy a portion of that purchase order from them. When the artisan completes the order with, let's say it's IKEA, and the total amount for the order is paid, Powered by People gets paid back, and the artisan gets the remaining amount. And this is short-term financing that can be used. And what the innovation here is that it can be done very, very small amounts. What's interesting is that invoice factoring, which is what this is actually the oldest form of financing that we have. So traditionally, the ships used to use it, as they used to essentially pre-sell their goods before they left to be able to fund their actual voyage. So it's a very, very old type of financing that has been, and again, this is where innovation is not just new things. It's sometimes making very old things relevant.
Now we've got 45 minutes in, and we've got the question that we've been trying to dodge from Lewis, and I think Sherry, you. Essentially, how do we keep the social return, financial return in some kind of lockstep? I mean, if you're looking at, and Lewis talks about in his question, possibly relatively low return, high impact investments, it might be a scale question in, solar or cook stoves or whatever it is. Is that a different kind of, are we talking about this is a more charitable play, this is a blended model to get the numbers right? Do these innovations you're seeing allow high impact, non-risk adjusted returns to somehow be magically managed in the structure?
So I think, so it's a great question, obviously. So there are options here. I think, again, as you know, both the course and the book are a big spectrum. So in this case, really, we're talking about kind of debt and equity, as opposed to necessarily, I can bring up a slide, we can talk about, there's a whole section on the book around impact linked financing. And so the question is around, should you as a funder potentially trade off, and is there willingness to trade off? That can be done with new structures. So I'll just quickly share a screen here from the book that is impact linked financing. I break it down in a few different ways. You can link to the cost of capital, you can link to how funding dispersed, you can link to ownership, convertibility. There's a lot of ways as a funder, if you want to, if you have the ability to, either internally or by partnering with an outcome funder, you can set up a contract that actually doesn't necessarily look for risk-adjusted return and is able to invest in the type of companies that are prioritizing impact. Now, that being said, another really simple way to do this is to do things like revenue-based financing and redeemable equity at cheaper prices. So you can either link it to impact. So you can say, which I've seen done is very early still, things like redeemable equity, whereby the redemption cost goes down based off of social milestones. So you can do that. You can absolutely integrate that. Or you can do what I've seen some funders do, which is actually to take on something called recoverable grants, which are cheaper capital that sometimes only is required only the principal is required back, and then use that to do revenue-based financing, for instance. So there's multiple organizations that do that. They bring in grants or recoverable grants that they'll pay out, or low-cost loans. And then they go out and make investments using revenue-based financing, but instead of looking for 2 times, their capital back or a large percentage, they're actually doing it at a much lower rate. So you can do, for instance, Beneficial Returns does this, and they do low cost, they take in recoverable grants, and then they actually do different types of financing, but low cost loans at a very low rate. So 3-4%, so below market. So you can use, I think the thing that's interesting about this is that there's a lot of different ways that you can structure this. You can decide to link the impact to the financing and say that your financing costs 6%, but if you reach 1 million women, your financing is going to cost 3%. And that's one way to do it. UBS has done that with several of their loans, that they do impact linked loans. That's completely an option. Sinks, SIBs are examples of 3 tri-party agreements whereby an investor is looking for more market rate, but an outcome funder is willing to top up that rate. So the options are endless, really. And that's what the book is trying to show. But, and as you've said, Lewis, it's important to root it in what's needed, not what we can do, but really what are the underlying organizations actually need? So what level of innovation is actually needed? And so for me, that's what it keeps coming back to. So what does the entrepreneur or the nonprofit on the ground actually need?
So as we're getting much more into the real world now with cases and these great examples, how do you think these models let us bring local communities or stakeholders into this conversation, potentially as investors, or what models can we see there that really allow not just capital to flow to these ventures, but actually multiple benefits to come to the region, not just at the organizational level, but through the investment level. So in other words, the capital can recycle if it's invested by people within the region. What thoughts do you have about that?
So for me, Alex, this is probably the most important part, I would say, takeaway from me of the book. And it's, when we think about it, it's not just about, I think there's a couple different ways to frame this, right? It's about the local communities and employees, as well as thinking about inclusion and diversity and all of the ways in which the current investment structures just do not work for most people. They are exclusive, and they are, very minority driven, and, very beneficial to a very small percentage of the population. And so I think that we need to be thinking about investment structures, like we talked about. We also need to be thinking about the process. And in the book, I use this framing of sourcing, due diligence, structuring, and exiting to systematically go through the investment process. So for instance, for funders that are interested in how does their sourcing become more inclusive, you need to look at who's making the investment decisions. So is the deal team have a lived experience perspective that's diverse? Do you have scouts potentially, or advisors from different networks or communities, or sitting on within your team? For founders, are you looking at things like crowdfunding that would allow you to bring in more individuals that are closer to your problem? And then in the due diligence side, Funders can, again, you can look at decision makers. So peer-based decision making in due diligence, which has been used by Village Capital, which I talk about in the book, they've been using that for a decade. They essentially allow the companies in due diligence to make the decision around who deserves the capital. And they've invested in over 100 companies, 80% of which are still operating. And this participatory process is also, Meg Macy and Ben Roble in their book, Letting Go, talk about how do you actually crowd in participation within decision making. And then finally, the crux of it, I think, is exits. So for me, one of the most interesting parts of the book research was diving into employee and community ownership. And we just don't talk about it enough in impact investing. And just seeing it as an exit option is a really interesting one. So instead of selling a company to a large corporate or to a financial buyer, what if impact investors were really intentional about transferring all or some of the value of the company to employees and communities? And it's at first, when you first start thinking about it, it sounds crazy and it sounds very difficult. But when you start thinking about some of these structured exit options that we've been talking about, they actually can lend themselves really well to this. Over time, you're not looking for unbelievable returns. You're looking for a measured, structured exit that you can plan with a community or a set of employees. And there's funders that are doing this. Purpose Ventures is doing this. Actually doing a webinar on this specific topic with them tomorrow afternoon. The Candide Group has done this with multiple of their investments, where they use structured exits to transition to employee ownership. And I think for me, this is going to be a huge trend going forward, is impact investors actually looking at how do we focus on not just taking individuals from beneficiaries to producers and consumers, but actually moving to that wealth creation and accumulation perspective, and answering the question of why should just funders and founders own things? Why can't communities own businesses? Why can't communities own real estate? And how does that look? How does that work? And some of these non-VC options are really interesting opportunities to be able to facilitate that.
And just, reality check, remember, cooperatives do this already, and they're
yes, of course,
around the
yeah.
world. I know this doesn't apply to what you're talking about here, but I mean, the co-op model is a model of common ownership that's been around for 150 years, and is a dominant form of ownership across many parts of Asia and elsewhere.
But Alex, the problem is that cooperative financing hasn't changed. And so a lot of the structures in the book, as I talk about, can be used for cooperatives and should be rethought about, because absolutely the cooperative model has been there for a long time, but how we fund cooperatives has actually not changed historically.
It's true. Well, we have a longer conversation about how they use debt, but that's a different conversation. Just building off the point we make about engagement, and I know we've only got 7 minutes left. Charlotte. Hi, Charlotte. Nice to hear from you again. Asked the question about, is there a gender lens element to this question about participation and engagement we've been talking about? How does that play out?
Hey, Charlotte.
Big question, right?
Well, it's an easy one, though. Yes, of course. We can absolutely put a gender lens in any of this. So I think that, for me, one of the things that I see, I've done gender lens investing for years and been part of the movement. But what we know from data perspective is that women are less likely to be hyperbolic in their pitch presentations than men. So you will have fewer women walk in and say, I'm the next Mark Zuckerberg. And so the problem is, of course, is that if VCs are looking for someone to tell them they're going to grow exponentially, otherwise they won't invest. If women are walking into rooms and saying, I'm going to get you very decent returns, as opposed to, I'm going to grow, to be bigger than the moon, then often they pull themselves out of contention. And so I think what we've seen from the experience of the investors that have adopted some of these structured exits approaches is that their ability to work with underrepresented founders, including women and people of color, is much higher. And it's partially a presentation thing, but then it's partially a preference. So a lot of these founders that are saying, I don't want to be the next Mark Zuckerberg, I actually don't want to grow a Facebook. But I think that there's 100% of an ability to, when we're thinking about the process and the structures, about making them more inclusive, to add a gender lens.
And then just a question from Von Leong about a regional focus. I mean, where do you see these models working everywhere? And the question is particularly about Southeast Asia and what might happen there that would be optimal. Many of your cases are, well, they're from all over the world, right? Pretty much. So, but I mean, context, I guess, does matter to some degree.
It does, but I think that, so I purposely, putting together the book was a puzzle. I had to find cases for each of the different structures, and I wanted them to be representative from a geographic perspective, from a gender perspective, from a race perspective, all those things. And so there are examples from every region, and pretty consistently throughout the region. I think that the thing to remember is that, these contracts are able to be quite flexible, and I'm working on a lot more companion material, which I had to pull out of the book because it was too long, but that'll kind of help investors as they start to contextualize some of these contracts. But they're much more contextually relevant than the traditional VC or debt model, because they don't have the same underlines. And so I think that there's no reason that these models can't be templated differently in different places. So instead of taking the Silicon Valley approach and trying to, put it into, Ho Chi Minh City, actually looking at and saying what type of enterprises in Ho Chi Minh City are thriving or need this type of capital to thrive, and how do you put that together? So I think that when you're thinking about any of these in emerging markets, I think a lot of times actually they're a better option than the traditional models, because in most emerging markets, we don't have the type of liquid capital markets that companies are looking to exit on. And so, making the traditional VC model work is just very difficult.
So we're almost at time, but maybe you can reflect in the last 2 or 3 minutes on the future. So, you've done this incredible work of analysis, you've collated this extraordinary, range of innovations that's going on around the world. If we take our mind back to 2.5 to 3 trillion shortfall in the SDGs, how do you see these innovations helping us accelerate the amount of capital? Clearly, they have lots of contextual value, and they may be more efficient, if you will, inverted commas, from an impact lens perspective in deploying capital. Do you see these as being scalable models to raise huge amounts of new money?
Yeah, I do actually. I think that there's going to be limitations. So, like, for instance, I see in the chat someone said revenue-based financing is challenging for low growth companies with seasonal fluctuations. Absolutely, I don't think that RBF necessarily is not necessarily low growth, but what I've seen, for instance, is low margin. Doesn't really work for low margin companies, particularly low margin, low growth companies. It's a difficult one for them, and so that's the math doesn't work. So I think what we'll see, Alex, is that if we have more templatized options for funding small and medium enterprises, is that a few different things. One, we can get capital out the door faster, particularly when we're using technology to be able to bypass traditional, due diligence, or going into a bank and having to, wire money from a bank. I think that there's a lot of ways in which we can make smaller deals quicker, and using technology like artificial intelligence, which is kind of in my wheelhouse. As far as emerging technologies and impact. So using things to make deals quicker, cheaper, and more relevant will allow us to get capital out the door faster. And then as you move up the scale, what we can start doing is starting to essentially bundle these types of deals and be able to then potentially even list them on public markets. There was a question actually that was submitted before the webinar around retail investors and what do these potential options look like. And it's interesting, there is a really good option for impact investing, listed impact investing vehicles that could work for this, but it has struggled. It's called impact investment trusts. I've tried to do one, others have tried to do them. Big Society Capital just did one successfully with Schroders, but another one just failed. And these are essentially by taking a bunch of these private market illiquid assets and listing them on an exchange. And we'll talk about in the course why these have failed thus far. But I do think that it's possible. And so as we're seeing the templatization and the cost and the bespokeness in some ways of these go down, but we have a range of tools. We'll be able to start rolling those up into larger funds, and potentially even into listed vehicles that we're able to then turn into, billions and trillions, which we'll need to be able to actually get the money out the door.
And on that wonderful positive note, we should wrap up. I mean, I think it's plain that this is a fascinating space, but also a really important space. Understanding how we align the enormous wealth and capital markets better with agendas around the SDGs, around empowerment, inequality, climate, development. These are crucial questions for the next 15, 20 years. And the work Arnie's doing is really contributing to us understanding the nuts and bolts of that. It speaks the language of finance to people who understand finance but don't necessarily understand impact, and we have to get those people on board as part of our conversation. So thank you so much, Arnie, for your contributions. Thank you everybody for taking part and for your great questions. I'm sorry if we haven't answered them all. I think we've answered most of them as best we can, and we wish you a very good rest of your day.
And join us on the course.
And join us on the course, yeah.
Or buy the book, or both. Bye, everyone.